Most equity markets entered bear market territory by mid-February, but have since rebounded strongly. Initially, this seemed like a short covering rally, particularly in the beaten down sectors of energy and resources. However, the magnitude and length of the recent rally has caught many investors by surprise. The central banks have continued to support markets, and with lower interest rates, and in some cases negative interest rates, more credit growth, it's really fueling investors' appetite for higher yields and risk assets. So have we seen a shift in sentiment or fundamentals, or is this merely just the central banks intervening in markets and giving investors increased confidence of prolonged low interest rates? The old adage of sell in May and go away has not played out at this stage, but we're still very early on in this period, so we think that caution is warranted. We expect volatility to remain elevated in the coming months as markets really question the economic fundamentals, valuations, and effectively the effectiveness of central bank policies. As we can see in this table, returns from the various asset classes have been mixed, with equities the worst performing asset class in the last year. Cash and fixed interest returns are subdued and are likely to get worse before they get better in the short to medium term. Australian equities have been negative over the last 12 months, primarily due to the large weighting to financials and resources. Unhedged global equities have been marginally negative given the fall in the Australian dollar, and Australian listed property returns have been exceptional as investors chase yield, although valuations are looking stretched. Commodity prices have declined marginally, although oil's down 23% for the year. Looking at diversified portfolio returns such as the Vanguard Balanced and Growth benchmarks, returns are very subdued at circa 1% for the year. This is what most investors can expect from their portfolios over the last 12 months. So why have equity returns been so poor over the last 12 months? Global earnings have been declining over this period, as shown in this chart. And in the absence of a pickup in sentiment and global growth, it is hard to see this changing in the short term. Market expectations also look too optimistic going forward, so if earnings continue to disappoint, then market valuations will likely come under pressure in the coming months. Then we look at the Australian share market, which has significantly underperformed global share markets since 2009. Outside of dividends, the market has provided zero returns for more than 10 years, and with the mining boom over and China slowing down, the Australian equity market may continue to be challenged. Investors need to broaden their investment universe beyond Australia when it comes to equities, or they may be very disappointed with the outcome. When it comes to the Australian economy, the outlook is mixed. Deflationary concerns caused the RBA to cut interest rates to a record low of 1.75% in May. There is also an expectation that the RBA will cut rates again this year. This suggests that the RBA is not overly optimistic on the outlook for the Australian economy. Record low interest rates are good for debt holders via reduced interest repayments. However, it punishes savers and those trying to live off retirement assets. For example, today, $1 million invested in a one-year term deposit earns around $25,000 on average. 5 years ago, the earning power on term deposits was more than double what it is today. And this brings us to the challenge facing all investors right now. The current environment has never been more challenging. Cash will not provide enough return to cover living expenses. Bond prices are in bubble territory and risks of capital loss are present. Australian and global equity markets are expensive relative to historical measures. Australian property prices are at or near record highs, and excessive leverage and speculation has really brought forward our future returns. So investors are going to have to get comfortable with lower return expectations going forward. In our view, most investors aren't focused on this new environment where cash doesn't provide an adequate return, bonds face capital loss risks, equities and property markets are exposed to substantial falls should macroeconomic risks become more elevated or play out. Looking forward, markets will focus on whether the US Federal Reserve will raise interest rates in mid-June, also the potential Brexit vote on the 23rd of June, obviously the Australian elections on the 2nd of July, and then we head into the US presidential elections on the 8th of November. So given these headwinds, central banks will likely remain accommodative and supportive of markets, so it's hard to get too bearish in the short term. It's arguable whether central bank policy actions have done more harm than good, and with interest rates at zero or in some instances negative, what other tools do central banks actually have? Well, there's now talk that central banks will initiate helicopter money, whereby they directly inject stimulus into the economy and bypass the banks via this mechanism. So whether this causes the next rally in markets or whether it's the straw that breaks the camel's back, time will tell. So at Morrows, we're focusing on one key question, and that is, are we being rewarded to take on risk? If the answer to that question is no, then we're quite happy sitting on the sidelines and waiting for a better opportunity to present itself. Thanks for listening to this update, and please contact your advisor if you've got any questions or would like to discuss your portfolios in more detail.